Good morning, everyone. A very warm welcome to everyone to this live session for a revision of CA Final Advanced Financial Management, topic of portfolio management. We have started with this revisionary session in the previous class for the topic of portfolio. And today we'll just take it forward with the remaining concepts to be revised, and then we'll be taking up the case scenarios, guys. Okay, so last time we have completed Markowitz portfolio theory, right? We have completed the Markowitz portfolio theory with the concept ending at efficient and inefficient securities, and also creation of the efficient frontier. Okay, so now let's just take it forward with the further discussion about the capital allocation line and then the capital market line. Now, one shortcoming or a point of view which was missed by Markowitz in its portfolio theory was that it did consider that we may have a efficient frontier like this, right? But it actually failed to consider one more fact, that the possibility of having a risk-free security in the portfolio. So when we consider the possibility of having a risk-free security, which means basically earning some amount of return, even without taking any sort of risk, right? So that's what we call it as a risk-free security, right? So when we consider that as a possibility of having a risk-free security, okay, then the situation changes, and we are faced with a new scenario of including risk-free security in our portfolio. So what we generally see is that if we have this particular frontier as a efficiency frontier, and if I consider having a risk-free security into our also in our portfolio, so now we are faced with a situation wherein I can actually combine this risk-free security with any of the securities on the frontier. Okay, so if you're combining, let's say, risk-free security with A, then you will get a line like this, wherein the position over here is going to indicate 100% investment in risk-free, and the position over here is going to indicate 100% investment in the security A. Right? The same way, we have a risk-free security and B, so you can just combine them, and you can just continue combining them till you reach a point of tangency. And when you reach a point of tangency, that's going to be the new efficiency frontier. Right, so this is going to be the new efficiency frontier. All the points which are lying below the efficiency frontier, below this line, become inefficient, and they automatically will adjust their prices. And as the prices fall, we know that the expected return increases. So these expected return may just go up. And so the expected returns, it may just go up. And you may have, this particular line as the new efficiency frontier. Okay. And when you see that the entire market, when you are creating this line, that's called as the capital allocation line, because that's the line of tangency between the efficiency frontier and the risk-free security. The capital allocation line is the line of tangency between your efficiency frontier and the risk-free security, guys. Then when we look at the other aspect of capital market line, so the line formed when all securities are going to shift from this efficiency frontier to the capital allocation, because the entire market is staying over there. So now that becomes a capital market line. And the equation of this capital market line, it is like this. Return of portfolio will be risk-free security plus standard deviation of portfolio upon standard deviation of market into RM minus RM. Right? We have derived this in our regular sessions. Now, also we need to understand that this particular return of portfolio, uh, this is not your capital. I mean, this is your capital market line, but this is not your CAPM. CAPM is just an extension over there, over this. And the CAPM takes into account that we are going to have two parts of the risk, which is one is going to be a unsystematic risk, another will be a systematic risk. So when it comes to unsystematic risk, it is a risk which is very much specific. It is a risk which is very much specific to the investor. I mean, specific to the company, and is going to differ as per the company or as per your investment. So this is your unsystematic risk, which obviously can be reduced, or in fact, which can be eliminated totally with increasing number of securities. So all of us agree that if you have more than one security in your portfolio, it's obviously going to be less riskier as compared to a single security. So if you just keep on adding more and more securities into your portfolio, the risk reduces. But remember, it is an unsystematic risk which reduces. But you will be faced always with the systematic risk. You will be always faced with the systematic risk, right? So unsystematic risk can be eliminated by diversification, but systematic risk is something, which can't be done away with. But yes, the total risk is going to be systematic plus unsystematic, and a rational investor is going to be in the market. So that's going to be an assumption over here that we are going to have an investor who is a rational. Obviously, any rational investor is not going to stay invested in a single security, but he or she is going to stay invested in a multiple security portfolio. So rational investor objectives, we can say it is minimize or remove the unsystematic risk. So rational investor's objective is to minimize or remove the unsystematic risk, and also CAPM would be, risk premium will be offered only for the systematic risk, right? So whatever amount of systematic risk you are carrying out, only for that you will be paid a risk premium and not for the total risk premium. So therefore, we say RF plus instead of beta, we say standard deviation security or standard deviation of market into return of securities. So correlation between security and the market. This correlation is going to ensure that only systematic portion of the total risk of security is used for asking the premium. And this particular part is what we call it as a beta. So we can have multiple formula of beta, which is correlation into standard deviation security over standard deviation of market. Then you may have this as covariance upon variance of market. And of course, the derived other formula could be used. Okay. Then conceptually, after this thing, we had the next model called as the characteristic market line or sharp single index model. In this sharp single index model, we create the return profile of a security by using simple regression, wherein we say return of a security will be equal to portfolio performance measurement. There were three tools using which we evaluated the performance of our portfolio. One is a Sharpe ratio, wherein we take the return of our portfolio minus risk-free divided by the standard deviation. Trainer ratio is return of portfolio minus risk-free divided by beta. Jensen's alpha is return of portfolio minus any CAPM return. So this is like the Sharpe ratio is going to tell you what is the risk premium that you're getting for every unit of standard deviation. Trainer ratio is going to tell you what's the risk premium that you're getting for every unit of beta. And Jensen's alpha is anyways the, risk premium over the CAPM return. So it's going to be return of portfolio minus the CAPM return based on the risk or based on beta. Now, this could be also a measure of whether the portfolio has underperformed or outperformed. If it is positive, If this Jensen's alpha is positive, this simply means that return of portfolio minus CAPM return. If this is positive, it means the portfolio has outperformed. It means that you're getting a return which is more than your required rate of return based on risk. Whereas if the portfolio is negative, it means you're getting a return. The portfolio has underperformed, which means it has provided you with a return lower than what you're expected to do. Okay, and then if it is zero, then performance is going to be at par. Okay, so these were the concepts that we were looking into at portfolio. Now let us do certain case studies on them. Okay, can we see the case scenario, guys? Yes. Can you see the case scenario, Saminathan, Lavanya?
Yes, sir.
Yeah. Okay, so shall we do the same way as we did in the previous lectures? You'll try it first and then I'll take it up.
Yes, sir.
Yeah. Okay, just go ahead, guys. Try to solve this. It's a fairly easy question. But yes, it involves some amount of calculations.
Sir, done, sir.
Okay. So here we have this data of probability, return on stock A, return on stock B, and the market portfolio. The risk-free rate is given as 8%. Covariance between stock A and market portfolio is given 122.7. And while covariance between B and market portfolio is also given. So assume CAPM framework is valid in this market, and we have to answer them. So expected rate of return, let me just solve it. Yeah, so we have probability, then return of stock A, return of stock B, and market. So probabilities are 0.3, 0.4, 0.3. There is 16, 14, and minus 9, 19, 16 minus 7. Market returns are 18, 15, and minus 8. Okay. Another question is expected rate of return of stock A and B. Okay. So expected return of A, and that will be probability multiplied by A. This probability multiplied by A. Then the next is probability multiplied by B. So probability into B. Okay, so expected return of A is 7.7 and expected return of B is 10. So correct option is 1C, right?
C.
C.
Yes, sir.
Variance of market portfolio. Now, variance of market. So variance of market, for that we need to get the expected return of market first. So expected return of market will be this particular number, which I'll take it as probability into the market. So probability multiplied by market returns. So your variance of market is 9. Now sorry, not 9, my bad. Expected return of market is 9, but we need variance. So for variance, it's going to be probability multiplied by market minus expected market square. So it's probability multiplied by market return minus expected market return, which is 9. And then we take the square of it. 125, variance of market is 125.4. Variance of market is 125.4. Option D.
Option D.
Correct. Okay. Then the third question is, what is the beta of stock A and stock B? Now, beta of stock A will be covariance between A and market divided by variance of market. Okay, covariance between A and market is given, right?
Yes, sir.
Covariance between A and
122.7.
market is 122.7. It's 122.7. Divided by variance of market is 125. So beta of A is 122.7 divided by 125. So that's 0.9784. And then we look at beta of B will be covariance between B and market upon variance of market, which is 122.7 divided by variance of market.
Sir, 125.4. Covariance of beta and market.
Covariance is how much?
125.4.
125.4. So it's 125.4. Yeah. So this is variance beta of B is 1 then. So option C, right? Third option C is
C.
correct. Perfect.
Yes.
Then required return of stock A and B is going to be. Now remember, they're asking you the required return. So how do we calculate this required return?
CAPM.
CAPM. Perfect. For that, we have the risk-free rate given in the question, right? Yes. So CAPM return of A, it will be risk-free rate of 8% plus beta of 0.9784 multiplied by RM. What's the market return? Expected market return was 9 minus, it's going to be, of course, 9% minus 8%. So this is 8% plus 0. This multiplied by 9% minus 8%, 8.98%. So CAPM for first one is 8.98, and for the second one, which is CAPM of security B, this is going to be 8% plus 1 into 9% minus 8%, which is of course 9%. So 8.98 and 9%. So,
C.
yeah, 8.9785. No, option A, right? Option A is accurate, right? 8.9785.
Sir.
The option
Yes,
is
sir.
9875.
Yes, sir.
Right? So option A is correct for the fourth one. Now, the fifth question. Which of the following statements is correct for purchase or sale of stock A and stock B? So which of these statements are accurate for purchase or sale of stock A and stock B? Stock A has a positive alpha, stock B has a negative alpha. So for that, since we have this CAPM return, and what's the expected return? Expected return is 7.7, and expected return of B is 10. So expected return of A is 7.7, expected return of B is 10. So expected return of A is 8.97, and this is 9%. So expected return of, if you look at which one is having a alpha positive, expected return minus the CAPM return. Here we have, this is, let me make it as percentage. So these are the percentages. Oh, my bad. That's just crashed. Just a moment. Okay, so A is having a negative alpha and B is having a positive alpha. So stock A has a negative alpha while B has a positive alpha. This means stock A is overpriced and stock B is underpriced. Therefore, sell stock A and sell and purchase stock B. So option C. Fifth option is going to be C.
Yes, sir.
Yeah, perfect.
Yes.
Okay. Then the next question that we'll take up is Okay, so here we have this question or case scenario number 20. Try out this one, case scenario number 20, guys. Give it a try, case scenario 20. Okay, guys. So here we go. An investor is evaluating two companies, X Limited, Y Limited, to determine which company is better investment. So both companies have different expected return and the standard deviation and the betas. So X is having some expected return, standard deviation, and beta. So let me just take down the data. So X and Y. X is having an expected return. So we'll write down the return as what? 22%. Standard deviation of 40%. Right. And beta is 0.86. Okay. 1 second, please. Okay, so Y is 24%, standard deviation is beta is 1.24. Okay, so and then correlation is which company is expected to be more volatile in absolute terms. So more volatile in absolute terms, it's going to be company X. Mhm. Hmm. Hmm. So it is security X, which is more volatile, right? Correlation implies that 0.72 stock are perfectly correlated or strong positive co-movement. Option C. If correlation between X and Y is zero, then portfolio risk will decrease, right? Because as a correlation becomes zero, you're going to have a decreased portfolio risk. What type of risk can be reduced by forming the portfolio? What type of risk can be reduced? So you can reduce the unsystematic risk. If market volatility increases but betas remain unchanged, the expected return as per CAPM will be betas remain unchanged. Market volatility increases but beta remain, the expected return as per CAPM will remain unchanged, because since the beta is same, your market the return expectation is also going to remain same. Okay, done guys.
Sir, first one for absolute terms, we will look into beta or standard deviation, sir.
Standard deviation.
Okay, sir.
Okay.
Okay. And the fifth one is if market volatility increases, we will expect more return, no, sir.
No, but beta is remaining unchanged, right? Beta is unchanged,
Okay.
right?
Yes, sir.
Okay. Start with question case scenario 24, guys. 24. Okay, guys. Mr. A is interested in investing 1 lakh, for which he is considering the following three alternatives. So 1 lakh in mutual fund X, 1 lakh in mutual fund Y, 60,000 mutual fund X, and 40,000 in mutual fund Y. Average annual return is given. Risk-free rate is 8%. Market rate of return is 10%. Covariance is given. Okay. So we need to get the standard deviation and all. Okay, standard deviation of mutual fund X. We have this covariance part given over here. Covariance between the securities and the individual securities. So we can get the standard deviation of mutual fund X as square root of variance of X, which is nothing but square root of 4.4. So what is the answer for this? Square root of 4.4.
Option A is at 2.0736.
2.07.
2.0976.
0976. Okay.
So B.
So option B. Portfolio return. Now,
B.
portfolio return, we have the annual return of portfolio X, Y as 11 and 12%. And we have invested, is considering investing 1 lakh, 1 lakh. Our portfolio return weightage will be 0.6 and 0.4. So 0.6 into return of X is 12% and return of Y is 11%. So 0.6 into 12% is
Option D.
7.2%. And this is 4.4%. So total is
11.6%. D.
11.6%. D. Based on standard deviation, the optimum investment for Mr. A would be, based on standard deviation. So if we look at the standard deviation number, okay, so we'll have to do like uh, X has got a standard deviation of 2.0976. What will be standard deviation of Y? Standard deviation of Y will be square root of 4.2, which is
2.05.
2.05.
Yes.
Now, I also need to whether it should be investment in portfolio or X and Y individually. So for that, I need to get the portfolio uh, standard deviation. I need to get the portfolio standard deviation. For that, we have the portfolio standard deviation as, no, this is market portfolio returns, wait. So I need to get the portfolio standard deviation. So for that portfolio standard deviation, we have to use Markowitz formula. So standard deviation of portfolio can be computed as square root of 0.6 square into, which is mutual fund X square, into standard deviation of that square, which is 4.4, plus 0.4 square into 4.2 plus 2 into 0.6 into 0.4 weight of X, weight of Y into 2 into 0.6 into 0.4 weight of X into weight of Y into standard deviation of X, standard deviation of Y. Or rather, I can just use this correlation, which is 4.3. So what's the standard deviation of portfolio then, guys? Just solve this. This is standard deviation of X square into weight of X square, standard deviation of Y square into weight of Y square, plus 2 into weight of X, weight of Y multiplied by covariance. So what's the standard deviation of portfolio? Give me this number.
2.078.
2.078.
078.
Okay. So where do you think we should be investing? X, Y, or the portfolio? Hmm? X, Y, or the
Why, sir?
portfolio? Yeah?
Why?
Y, yes. Should be standard deviation of Y 2.05. So all investment should be made in mutual fund Y because it results in lower standard deviation. Easy, guys? Got it, everyone?
Yes, sir.
Okay. Let's go for the next question, next case scenario then. Okay, then try out this case scenario 37, guys. Start with this case scenario 37. Okay, let us start. Um, Two friends, A and Mr. N, were discussing about the risk of the market. While Mr. A is a sort of risk averse, Mr. N is an aggressive investor and believes in taking risk. Mr. N said we cannot diversify the market risk at all, and he quoted the modern portfolio approach. Both of these friends analyzed the market data for a few months and came out with expected returns on two stocks for a particular market. So we have two market returns, 7%, 25%, aggressive and defensive stocks. So for the information given above, to choose the correct option. Now, beta of defensive stock. Beta of this defensive stock. Well, when we have just two data points, we can actually get the beta as difference in returns of the stock upon difference in return of the market. This is like 18% minus 9% upon 25% minus 7%. So this is 9% upon 18%. Yeah. So option B. First is option B, right?
Yes, sir.
The expected return of aggressive stock if market return is equally likely to be 77 and 25. So expected return of aggressive will be 4 plus 40 divided by 2, which is 44 by 2, which is 22. 44 by 2, 22%. So option C. Then alpha of defensive stock. So we need to first get the expected return, which is 9% plus 18% by 2. So alpha, the expected return is how much? 9 plus 18 by 2. So that's what, 13.5%.
13.
Then beta, it was 0.5. So I can get the CAPM return. CAPM return will be risk-free rate is, what's the risk-free rate given is? Is any risk-free
Not
rate?
given.
Hmm?
No risk-free rate is given.
No risk-free rate. So then we can say this as this is expected return. We have beta as 0.5. So if beta is 0.5, I can say CAPM will be 0 plus 0.5 into market return is what? 25 plus 7 by 2 minus 0. So this is 0.5 into 25 plus 7, 32 by 2, 16. So that's 8%. So CAPM return is 8% and your expected return is 13.5. So the difference is alpha of 5.5, assuming the risk rate to be 0. Okay. Then, of course, the modern portfolio theory is propounded by Harry Markowitz. Then look at this one. As per capital market line theory, the portfolio lying on the CML over the market portfolio are called lying on the CML over the market portfolio are called borrowing portfolios. So it's like when you have this particular portion that this is your market and this is your risk free. So at this point, it's 100% risk free and 0% market. At this point, it's 100% market and 0% risk free. Now, if you're sitting over here, it means, of course, it is 1.5 weightage of market and minus 0.5 weightage of risk free. So this is a portfolio which is created by borrowing money, and therefore option is going to be B, which is borrowing portfolio. Are we clear with this, everyone?
Yes, sir.
Yeah, okay. Then try out this case scenario 48, guys. Look at the case scenario number 48.
Sir, is there fifth question, sir? Done, sir.
Okay. An investor is evaluating two companies, A and B, to determine which company is better investment. Both companies have different expected returns, standard deviation, and betas. So let me write down the data. So X is having 22% of expected return. Standard deviation beta is 0.86, and this is 2438. Correlation is 0.72. Standard deviation of market is 20%. Standard deviation of market is 20%. Then the portfolio's expected rate of return if investor invests 30% in B and 70% in A. Okay, so we have the weights as 30% and 70%, so 0.3, 0.7. Expected rate of return,
Sir,
sorry, yeah,
13 point,
13B,
13.
and this is 0.7, right?
Yes, sir.
So then we have the portfolio return. The portfolio return will be weight of A into return of A plus weight of B into return of 22.6%. Standard deviation of investors' portfolio if 30% is invested in B and 70% in A. Now, the standard deviation, portfolio standard deviation is square root of weight of A square into standard deviation of A square plus weight of B square into standard deviation of B square plus 2 into weight of A into weight of B into standard deviation of A into standard deviation of B into correlation between A and B. So portfolio standard deviation is 37.06%. %, yeah, option C. Then covariance between return of stock and A, returns of A and B shall be approximately. So covariance will be correlation multiplied by standard deviation of both. 10.1.1094, yes. Based on the data, the risk-free rate of return shall be approximately. So risk-free rate of return is going to be approximately how much? So for that, we'll have to say that 22% is equal to risk-free rate plus beta of 0.86 into RM minus RF. So 24% is equal to risk-free rate plus 1.24 into RM minus RF. Okay. So this is like the simultaneous equation, and we can solve this simultaneous equation to get the market rate of return and risk-free rate. So did we solve this and get the market rate of return and
Yes.
the risk-free? How much is
Yes,
market
sir.
rate of return?
Market rate, risk free 17.48.
Risk-free 17.4.
Yes, sir.
Okay, and what's the market rate of return?
22.74.
22.74%. Yes. So option is 17.48 and 22.74 over here. Okay. Okay. Then let's just take one more question on portfolio probably, and then we can go for the next chapter for revising. So the next question, I think there's no question left out for this portfolio. Okay, so I think, yeah, we're done with the case scenarios on portfolio. Let's do one thing, then let's take a break right now, guys. Break of 15 minutes, and then we can come back and get started with the next topic, which is about okay, which will be about the mutual funds. Okay, so yeah, let's take a break, guys. Okay, welcome back, guys. Now, let us go for. Are you all there? Lavanya, Saminathan. Yep. So let's go for the next topic to revise, which is about the mutual funds. So let's do some concepts first, and then we'll go ahead with the case study discussion. Now, mutual fund as a structure, it is established as a trust, guys. So it's going to be established as a trust, which is in which there are multiple parties which are going to get involved. So we'll have a mutual fund trust, and that trust is going to be collecting money from the public. Essentially, it's not the trust which collects the money, but it's the sponsor which takes the initiative of establishing the mutual fund. So the sponsor, for let's say SBI Limited over here, it's having a capital of 10 crores. Then it approaches to the public for raising the 990 crores, and the total money is contributed to the mutual fund trust. Okay. This total money is contributed to the mutual fund trust, and then this SBI mutual fund, total of 1,000 crores, is going to be given to SBI Mutual Funds Private Limited, which is your AMC. So money is going to be managed by AMC, right? And the ownership is going to be with the trust. Now there are multiple parties which are connected with this mutual fund. One is a category of your distributors, which is going to be into the activity of distributing units to multiple participants. Then you have the registrar and transfer agents who are responsible for ensuring the units are transferred. Money is collected against the issue of units, and also money is collected when the shares are sold, and the payments are made when the shares are purchased. So all those transactions are taken care of in the registrar and transfer agent. And then we are going to have the custodian who is going to hold the shares. Custodian is basically the person or the entity who is going to hold the securities. Now, one important aspect that we need to know in mutual fund is calculation of NAV. NAV is nothing but the market value of all the securities that the mutual fund is owning, plus the cash that it has, and then divided by the number of units. So total of assets less the liabilities is going to be your net assets, and then you have the number of units getting divided. You get the NAV as 11.15. Okay. Fine. Now, there are various types of mutual funds, which could be open-ended, closed-ended, or interval funds. Open-ended is the category of mutual funds which is open for subscription and redemption at any point of time. Closed-ended is that it's not open for subscription again and again. Rather, it's going to be closed for ever. I mean, once the money is raised, the mutual fund will not have any option of raising additional money or additional units. Rather, due to this feature, it's going to be listed on a stock exchange when you have certain interval funds. There are other funds also based on the area of investment, based on your investment style, based on the type of securities that you're picking up, right? So those are your portfolio-based classification of mutual funds. Uh, Now, of course, why do we want to go for mutual funds? It's because of the professional management, diversification, administration being convenient, higher return at lower risk, low management cost, because the transaction cost or the management cost is going to be capped by the SEBI guidelines. Liquidity, transparency, right? Economies of scale. Disadvantages would be, of course, there's no guaranteed return, and low return also possible due to diversification. And it's quite possible that the scheme where you're investing that may not be proper. We need to consider also the cost factor, which is the entry load, exit load, and the management. So entry load is the amount of fees or brokerage or transaction charges which you pay when you're buying a security, and exit load is the fees or transaction fees that you pay when you're taking exit from it. And then the management strategy, management fees. Management fees is paid every year as and when the management, as and when the company or the mutual fund is managing. So every year, this is the expense that the mutual fund is going to pay out. Okay. Uh, Now let us straight away go to the case studies, guys. Let's straight away go to the case studies of the mutual funds. Yeah. Case scenario number 2. Try it out quickly. Case scenario number 2.
Sir, done, sir.
Okay. So it's quite an easy question here. So Steady Mutual Fund at the close of business has got these 4 companies in which they have invested the shares and the market price. Total number of units of scheme is going to be 20 lakh. It is having accrued expense of 2 lakh, other liability 2 lakh 50. We have to choose the correct ones now. Total gross value of the scheme. Star Gold. Gross value will be simply number of shares into market price. Right. So what is the gross value?
420.20.
420. So is there any cash in the scheme? No, there's no cash, right?
No, sir.
No cash. So 420.2. You just need to multiply the number of shares with the market price. Then net value of the scheme, of course, 420.2 minus 4 lakh 50. So that's what? 415.7.
Yes, sir.
Right. And then this 415.7 divided by 20 lakhs. 415.7 divided by 20 lakhs. How much?
20.785.
Yeah, 20.785. That's option C. So first is option B, then C, and then again C. Right, guys? Easy. Okay. Then, yeah, let's go for question number 6. Okay, try it out. Question 6. Okay, done.
Yes, sir.
Fair Return Mutual Fund made an issue of 5 lakh units at rupees 10 each on 1st April 2024. No entry load was charged. The fund made the following investments. So the money that was collected How much was the money collected? 5 lakh into 10.
50 lakhs.
50 lakhs, out of which you have invested 49 lakh. So how much is the cash balance left with us? What is the cash balance? 1 lakh, right?
Option B. Yes, sir. Sir. But
Beginning
there
1
are
lakh.
expenses,
Yeah,
sir, 2
beginning 1
lakh.
lakh. But during the year, you received a dividend of 6 lakh. Interest on all debts were received as and when due, and operating expenses were paid during the year amounted to 2 lakh 50,000. So you start with 1 lakh. On that, you received 6 lakh dividend. Minus, you also receive the interest. So interest will be how much? 4 lakh into 7% plus 2.5 lakh into 9% plus 2.5 lakh into 10%. And from that, you subtract operating expenses which you have paid of 2 lakh 50,000. So what's the net cash balance that we have? What's the net cash balance?
5,25,500.
5,25,500. Right? Got it? Everyone? Okay. Second question. What is the total net asset value of mutual fund at the end of the year? Total net asset value of mutual fund at the end of the year.
57,75,500.
Total NAV. Of course, I need to, at the end of the year, equity shares and 10% debentures are quoted at 175% and 90% respectively. Other investments are at par. So we have a cash balance here, but equity shares will be valued at what? Equity shares and debentures are quoted at 175%. So it will be 40 lakh into 175 upon 160. This is the value of equity share plus 10% debentures. 90% of face value. So 10% debentures is basically 2 lakh 50,000 into 90% plus, and then the other things are at par. It's going to be plus 4 lakh plus 2 lakh 50,000. So what's the total? And of course, to that we will also add the cash balance of 525,500. So what's the total net asset value?
57,75,500.
57,75,500. If the mutual fund distributes a dividend of 0.6 during the year to the unit holders, anyway at the end of the year will be. Of course, if you are distributing this 0.6 as the dividend, you need to subtract that from this, and then the revised cash balance will come. And out of that, you divide it by the 5 lakh units. So that's going to give you the NAV of the mutual. So what is this answer? 57 lakh 75,000 minus 0.6. So it is 5 lakh into 0.6 divided by the 5 lakh units. How much is this?
10.951.
10.951.
951.
So 10.95. Option B is the correct one. Did you all get it?
Yes, sir.
Yeah, easy.
Yes, sir.
Okay. Then
Okay, so case scenario 26. Yes, I have this case scenario 26.
Done, sir.
Okay. So Mr. Y has invested in 3 mutual funds: mutual fund X, mutual fund Y, mutual fund Z. NAV at the time of purchase is given as 10.3, 10.1, and 10. Dividend is received up to 31st March 2023. Then NAV and then effective yield on 31st March 2023 is given. From the information given below, choose the correct answer. Now, total NAV of mutual fund Y as on 31st March 2023. So NAV of mutual fund Y as on 31st March 2023.
C, sir.
Option C. How do you get it?
Amount of investment divided by
Perfect.
initial NAV
Yes.
will get number of
8
units.
lakh divided by 10.1. This gives you a number of units. And then you multiply it by 10. Right, which is a closing NAV. So 8 lakh divided by 10.1 into 10. So what is this? 7 lakh 92. Total yield on mutual fund
7.
X in terms of rupee would be approximately. The effective yield over here is 9.66. But total yield, if I want to say, it's going to be like change in NAV, which is 10.35 minus 10.3 plus add dividend to it. So dividend is 9,000. 9,000 divided by the number of units. Now, number of units will be 4 lakh divided by 10.3, right?
Yes, sir.
And then
Sir,
this.
here it is asked in rupee terms now, sir. Can we take that?
So we can do, but we'll need the number of units anyways, right?
Yes, sir. For that 4 lakh divided by 10.3, if we do, we'll get.
And this is like the per unit form. And then again, you multiply the 4 lakh by 10.3. That will give you the full value.
Yes, sir.
Right? How much is it?
10,941.75.
10,941.75. So that's 10,941.75. Okay. Number of days for which mutual fund X is held would be approximately. Number of days for which mutual fund is held. For that, we'll have to say 10,941.75 divided by this number of units. So that it will give you, or I can just simply say this divided by 4 lakh.
Yes, sir.
Into 365 by X days into 100 will be equal to 9.66. And when you solve it mathematically, what is the value that you are getting?
103 days.
103 days.
Yes.
Yes, option C. 103 days, guys. Okay. Great. Now, same way you have to calculate for mutual fund Y, but that's okay. You can do it later on. Let me take another question, which is hmm, 38. Try out this question 38, the case scenario 38, guys. Let us solve this. Case scenario 38. We done, guys?
Doing, sir, 2 minutes.
Okay, doing. Just a couple of minutes more and then we'll discuss it. Okay, so let's start with this. See, Mr. X on 1st July, during the initial offer of some mutual fund, invested 10,000 units, having a face value of rupees 10 for each unit. Then on 31st March, the dividend paid by the mutual fund was 10%, and Mr. X found that his annualized yield is 153.33%. So as on 31st March, his yield is 153.33%. On 31st December, again 20% dividend was given, and on 31st March, X redeemed all his balance of 11,296.11 units when his annualized yield was 73.52. Now, let's do it one by one. So NAV as on 31st March 2022. So as on 31st March, the mutual fund has paid 10% as dividend, and annualized yield at that time was 153.33%. Now we know this 153.33% would have been arrived at from uh, the closing NAV. So let me take it as NAV1 minus the opening NAV, which is of course 10, right? And then uh, on that, you have also paid a dividend of 10%. So plus a dividend of 10%. So that will be 10% means for every unit, it's going to be 1 upon 10. But remember, this 153.33 is the annualized yield. So I need to make it annualized. We just multiply it by so how many months do we have? Like from July 1st to 31st March. So it is what, 9 months, right? July to uh, December, it's 6 months, and the other 3 months. Okay. So it is into 12 by 9 into 100. So when you solve this, you should be able to get the NAV as on this date. So what's this?
20.5. 20.5.
How much?
20.5.
20.5, yes. So option B. Then total number of units that will be approximately is asked for. Now over here we can definitely say that the whatever dividend is being paid out, that is being paid out by way of units. Okay, because you can see the closing number of units is 11,296. Of course, as the units are increasing, it means the dividend is being paid out as in the form of units. So over here I need to get the dividend units. Now dividend units will be 1 into 10,000 divided by 20.5. 10,000 is the amount of total dividend. Okay. And each unit is being trading at 20.5. So dividend units, how many units will be allotted as dividend is? 10,000 divided by 20.
487.8.
Sorry, how much?
487.8.
487.8. So of course, total units that we will have is original 10,000 plus 487.8. So 10,000, 487.8. So option A is correct. Then dividend as on 31st March 2023. As on 31st March 2023, the dividend will be 10,487.8 into 10 being the face value. 10,487.8 into 10 being the face value. And the dividend paid by the mutual fund is going to be
20%.
this is 20%. So into 20%. How much is this?
20,000. 20,975.6.
20,975. Then finally on NAV as on 31st March 2023 will be, so NAV as on this date, we can definitely say this can be computed because we have the amount of dividend as 20,975. So 20,975.6. This needs to be divided by, because here the 20% dividend was paid, right? So now we want it on 31st of March 2023. Okay. So as on December 21st, it was given. NAV as on 31st March. Okay. So on 31st March, dividend was paid. X found that his annualized yield was this. Then on December 31st, 20% dividend was paid. Okay, so this should be some mistake. I think on December.
Sir, if we add opening units to the dividend units, we will get 11,296, no sir, closing units.
So you're getting that closing unit, but this is as on 31st
From that
March.
we can get NAV, no sir.
From that we can get
20,975.6 divided by NAV of 23 will give us dividend units, no sir.
Will give us dividend units. Yes. So
20,000. To that, if we add opening units, we will get total units.
So
the total units are 11,296.11.
Yeah, total units is 11,296.11. Right? So as on 31st March, dividend is this much. Now this needs to be, yeah, so this is the amount of dividend. I need to divide this by the NAV, right? Plus 10,487.8 should be equal to 11,296.11. This is the opening units. This will be the dividend units. Total should be 11,296. Right? So that will give you the NAV answer. So what is this answer, NAV?
25.95.
25.95. Then one last thing. As on 31st March 2024, what will be the NAV? That will be 11,296.11 into the NAV as on that date, right? Minus the initial investment of 1 lakh. Upon 1 lakh, multiply by, how many months do we have this as? 2021. So you have 9 months.
33 months.
How much?
33.
33. Okay. Yeah. So this should be equal to 73.52%, right? So when you solve this, what's the NAV that you're getting?
26.75.
26.75. Got it, everyone?
Yes, sir.
Okay. Fine. So with that, we are through with today's session. We have done a couple of case scenarios for the mutual funds. We have already completed the portfolio. Now, what I am left to do is the some more couple of more cases on mutual funds, and then followed by case on discussion on business valuation, which we will be doing it on Thursday, guys. Okay. So thank you for your patient listening, guys.
Okay, sir. Thank you, sir.
Thank you, guys.
Thank you, Jagbandhuji. Thank you very much. Student, thank you very much for your patience and making this session very interactive. Now, almost we are only one class has been left for the live revisionary session for the paper Advanced Financial Management. So, in the next class, on the coming class, the course will be over. Now, student, as you know that the purpose was just to give you a just kind of a revision, and now we are also coming out with the mock test series also. So you are requested to attempt the mock test in examination like condition and assess yourself. And one more point, Jagbandhu sir just share our mobile number, contact number as well as our email ID, so that student can contact us. So and since this case study, we have also come out with a new case scenario booklet that is available on website. So you can also, I think Jagbandhu sir, you are referring the same, sir.
Sorry, sir.
You are also referring the new case scenario booklet, na sir?
No. Yeah, as per the new case scenario.
Yeah, new case scenario, na? Yeah, that's why. Because in earlier it was 35, now number has been increased.
Yeah, it has increased. Yeah.
Okay, student. So you also refer the same, okay, for the other topics as well. So in the next class, the mutual fund will be continued and business valuation, last topic, remaining topic of the syllabus will also be covered. So just Jagbandhu sir, just share our contact number 0120. Just write it here, no problem. Yes, so this is our contact number and email ID. Still, you have any query, you can send us to the same. And student, before we leave, wish you a very happy Holi to all. Okay, celebrate the Holi with the colors and joy. Thank you very much and have a nice day. Thank you.
Thank you.
Thank you, sir.
Bye.
Thank you, sir.
Thank you.
Thank you, sir.
एक मिनट रुक जाइए just okay concluded. Thank you. कौन है ये एकदम